and now we are joined with another guest. We have Sanjay Sinha, founder at Citrus Advisors, also joining us from the BSE. Sanjay, thanks so much for being with us at NDTV Profit. It seems like it's a very festive affair at the BSE, and there's a lot of hustle and bustle right behind you that we can see. Tell us what does it feel like for you to come to the exchanges on this auspicious day and for the trading to take place? How is it different from any other regular day?
Okay, so first of all, happy Diwali to you and to all your viewers. You would know that, I am actually not a regular visitor to the Bombay Stock Exchange, but I do make it a point to be present here on every Diwali, because the mood here is not only festive, it is very, I would say, social, because there are many people who come here, people like me, who would not normally be coming into the convention hall, unless, of course, there is some other occasion. And there are so many people who come today on the day of the Diwali Muhurat session, because they relive a lot of happy memories of the year gone by, and also exchange notes about what do they think about the markets going forward. And this probably becomes the basis for whatever be the trading patterns that emerge in the market over the next couple of months. So, the roots of this Muhurat ceremony, I'm sure dates back to those days where there was an open outcry system that used to be performed in these very halls, where there was no electronic trading. All transaction used to be by symbols and signals. And from there we have come to now a time when everything is automated. Actually, the automated trading on the Bombay Stock Exchange actually was ahead of the trading even on the New York Stock Exchange. New York Stock Exchange was much later than Bombay Stock Exchange in terms of adopting the automated trading system. And I think that itself is the India story. In many ways, we are ahead of the world, but we don't acknowledge that fact. And today, when you look at the global context, I think in the global context, the Indian economy is far ahead of many of the world economies, whether developed or developing. And we need to acknowledge that fact, take cognizance of that, and encourage the equity culture in the country, so that people at large do get a share of the prosperity that India has to offer.
Right, Sanjay, as you just started by saying that you are not a regular visitor to Bombay Stock Exchange. Last year, I remember talking to you live from BSE. So was that the first year, and now it's the second year? So regularly you will start to come at BSE?
No. So I come here every Diwali for the Muhurat session, because I like the festive atmosphere of this place on the occasion of Diwali.
Right. As far as the point that you made in the start, that how it essentially has been a very okay year, but with a positive bias. Can you just also tell us that what is the discipline that you will tend to look when you invest now in this year? What is the learnings from last year? What are the sort of lessons that you have learned which you will implement?
Okay, so if you look at the behavior of the market, at the end of the day, Pankaj, this is an equity market. An equity market will not be devoid of risk at any point of time. There will be certain level of uncertainties that will keep influencing stock prices at a point of time. I think what is important is that, if you look things in a little longer perspective, you will find that the short-term uncertainties that affect stock prices do not necessarily have a very large influence on the stock price behavior or the market behavior on the longer term. Now look at the last 1 year itself. When we started the Samvat 2072 on the 11th of November last year, the Nifty was at 7,825 points. The Sensex was comparably at the same level where it is today, minus about 8% below where it is today. But then, it was not as if, it has been a steady 8%, 10% rally that we have seen in the market. We actually saw a 13% to 15% retracement in the market when we were coming to the end of February. So if you had taken a call on the market that, everything is going to be hunky-dory and therefore put all your money there, you would probably be ending the year with about, say, 10% return. But then if you had probably staggered your investments across the year, and some of your investment would have got deployed in the end of February, that investment would be sitting on a 30% return. That is one learning that I think we should take in our stride, that there is no such thing as the perfect time in the market. Every day is a perfect time. What is important is that your investment allocation should have a time horizon that should be a little longer than just 1 year or a few months. So that is one thing that is important. Second thing is, look at the sectoral behavior of the market. Who would have imagined that the leading sector of the market in the last 12 months would be metals? Who would have imagined that the leading sector of the market would be real estate, the realty index? So herein lies the story, that there is no such thing that whatever has rallied in the past will rally in the future, and what has not rallied in the past will also not rally in the future. The star performing indices of the market for the last 2-3 years have been the IT and pharma. The IT index has actually been a laggard in the last 12 months. Prospectively, if I look at the next 12 months, I do not see a very optimistic outlook as far as the IT sector is concerned. The outlook on the pharma, I would say, would be relatively better than the outlook on the IT sector. But I would be a little doubtful whether it would be able to demonstrate the phenomenal return that it gave in, say, the calendar year 2014 or the calendar year 2013. So from here, prospectively, when we look at the market, I feel that, what are the thematic plays that are happening? I think one of the most significant things that is happening in the market is the developments related to the banking sector. We have seen a change of guard at the Reserve Bank of India. The new governor maybe is not very charismatic, but he has come with a different approach. One of the key tenets of his approach is that he says that he will take a more pragmatic view by way of recognition of the NPAs and dealing with these issues as far as the banks are concerned. I think if this happens, it will come as a big relief to the public sector banks, which have been laboring under the load of accumulating NPAs and a larger disclosure of the NPAs in their books. Now the fallout of this recognition of NPAs has been that the credit growth actually has got very stunted. Last 1 year, the credit growth on an overall basis has been less than 10%. Now you cannot have the Indian economy growing at 8% or 8.5% with a credit growth in the vicinity of about 8% or below these levels. Now if I look as to where the credit growth has happened last year, the credit growth has largely happened in the personal loan and the housing loan portfolio. The corporate loan portfolio has not grown. So you will need to spark certain amount of borrowing from the corporate sector also. And I think this changes which are happening in, by the way, the new governor at Reserve Bank of India is dealing with the issue of recognition and resolution of the NPAs, I think is a big theme to be played prospectively, and therefore I believe that the banking and financial services sector would be again one of the leading sectors of the market in the next 1 year. The second theme that I think is equally powerful as far as India is concerned, when we have a global slowdown, then in that background, the only thing that can keep the Indian economy vibrant would be domestic consumption. So some amount of this domestic consumption has got fired by the 7th Pay Commission. Some amount of this domestic consumption is still in the pipeline, which will be now getting fired once we have the harvest of the good monsoon that we have witnessed this year, translating into purchasing by the rural economy. So these consumption theme will actually spawn a lot of sectoral, I would say, upswings. Key among them would be auto, and I think we could take a play on that. So these, I will say that, don't be guided by a very narrow and a myopic perspective that the market is for here and now. The market actually for you is there every day. Stagger your investment and time it with a particular purpose. Second is sectoral picks will surely have a significant role to play in terms of how your wealth gets created. And within sectors, stocks that you select will also be an important factor in deciding as to how your portfolios grow. So this is, in my, I would say, summary opinion, the lessons of the last 1 year, which give me a direction for the next 1 year.
For people who are probably linked to some other job and not equity job, you think going via mutual fund, PMS, or taking professional advice should be prudent? Because, we are seeing some of the stocks react more than 20-30% if there is any news flow, whether it's positive or negative. So markets are getting more efficient, and that's why one should take professional advice.
Yeah, that is surely there because, one thing which has kept a large majority of the Indian population away from the equity market has been the fear that, if they enter the market, they will burn their fingers. But if this is done in a little professional manner, then they will stand to benefit even by participating in equity. On that count, let me share two studies that we did in the recent past. I think February of 2015, the Sensex was at 29,000 points. August of 2016, Sensex was again at 29,000 points. So if you compare the point-to-point return from the Sensex, maybe between these two dates, the return was 0%. But during the same period, the average return from equity mutual fund was 9%. So that was the extra return that the professionally managed funds, with the help of the managers and the analysts and the research support that they have, were able to create wealth for the investors. There was another time period that we had studied, which was, I think that was June of 2014. The Sensex was at 25,000 points. April of 2016, Sensex was again at 25,000 points. Again, between these 2 points, maybe the market was flat. But during these two dates, the average return from equity mutual fund was as high as 14%. So I think herein lies a number of statistics that will be giving that confidence to an average investor, a retail investor, to come forward and participate in the equity market. Now this also gets supported with what is happening to the other asset classes. Real estate used to be the darling of the market, a lot of investors, but the real estate market has been quite flat for the last, I would say, 2 years plus. I do not see the heady rally in property prices that we saw between 2004 to 2013 getting repeated in the near future. It will happen, but it is a few years away. Gold was also another attractive asset class, but it has not performed for a long period of time. Last 1 year has been an exception where I think the gold has given a return of about 70%, but you cannot extrapolate, as that is something that can be enduring every year. So given the fact that there are limitations to the wealth that can be created in other asset classes, people are getting driven to financial assets, and within financial assets they are making choices. And with the decline in the interest rates, I am quite sure the interest rate on deposits will also be coming down. So by force, people will have to divide their investments between fixed income securities and equities. And I think that is something which India is going to witness over the next, I will say, 2, 3, 4, 5 years. And that trend is going to be a very, very heady trend.